Alright, what's going on, everybody? It is Econ with Dave, back with another video. We're looking at Berkshire Hathaway Class B shares. So Berkshire holds an enormous cash hoard. As the latest data, cash and equivalents are $76 billion and short-term investments are $305 billion, totaling $381 billion in high liquidity assets. On the other side of the balance sheet, the total debt is around $127 billion. This is interest-bearing short-term and long-term debt together. The remainder of the liabilities consists of non-debt obligations, insurance floats, policy reserves, payables, deferred taxes. In fact, total liabilities are around $525 billion. The other non-debt liabilities on the order are $398 billion in summary, all right? The liquidity is massive. When you look at it, it's over $382 billion in cash and investments versus a modest debt load. Net cash is $254 billion minus debt, underscoring the debt is a small portion of the balance sheet. Berkshire could today pay off all of the debt and still have over $250 billion left over, a sign of strong balance sheet strength. Other liabilities primarily relate to its operating businesses, as we've spoken about before, those insurance reserves, taxes owed, not money borrowed. The separation highlights that Berkshire's leverage is low. Debt to equity is looking roughly at 0.18. And most liabilities are operational in nature rather than creditor claims. On top of that, let's look at the actual operational flow itself. Trailing in the last year, the net income, which was $67 billion in September of 2025. Let's always remember, though, net income includes large investment gains and losses. When we add back non-cash expenditures like depreciation and amortization, we have to look at a minus of almost $13.2 billion. Since these reduced accounting profits, they did not use cash. Berkshire had no significant asset write-downs in recent years. The lines for asset write-down and restructuring cost is blank from 2021 up until 2024 after a one-time $10.64 billion write-down in 2020. Next comes the capital adjustments, changes in operating assets and liabilities that affect cash. For 100% example, an increase in accounts receivable or other current assets in a use of cash, while an increase in payables or the accrued taxes is a source of cash. The provided cash flow statements show large swings in these items. Changes in accounts receivables was $40 billion, meaning receivables grew using cash, and conversely, change in income taxable payable was $87.38 billion. Current taxes jumped by adding cash since these taxes were not technically paid yet. Such a huge tax accruals reflect gains that generate tax obligations, and this is effectively a temporary short-term amount of cash. There is also adjustments for inventory, accounts payables, and other accruals. Each list change in lines, which in aggregate can be quite large for Berkshire due to its many subsidiaries. After summarizing all of the net income, adding back non-cash changes, and adjusting for working capital, we get a net cash provided by operating activities for the last 12 months at $39.4 billion. Prior years, when we looked at the CFO, were between 30 to 49 billion range. 30 billion in 2024, 49 billion in 2023, and 37 billion in 2022. Fluctuations are driven by the insurance losses and gains and working capital timing, and having a consistent, strong, positive operating cash flow is most definitely present. In addition, the cash flow from investing. Berkshire deploys cash into investments and acquisitions, so investing cash flow is often negative, an outflow. Key lines include capital expenditures. The cash Berkshire invests in property, plants, and equipment for its operating businesses, and purchases for the sale of investment in those underlying businesses. In the last 12 months, capital expenditures were about $20 billion of an outflow. Berkshire also makes large investments in securities, like buying stocks for portfolio insurance, or occasionally acquisitions of companies. These are captured in lines that are titled as investment in securities and or acquisitions. On the cash flow statement, while the exact amounts aren't listed in the snippet that we have in terms of our data set, historically, these Berkshire, net purchasers of investments will mean that cash flow is negative when Buffett is deploying cash. For example, in some recent years, Buffett spent tens of billions on equities and acquisitions. If it sells more stocks than it buys in a period, this would show up as a positive inflow. After summing up all of the interest investing, we get a net cash. Currently, that's a very large negative. It was a net negative $64 billion with an outflow in 2024, reflecting once more the underlying belief that the portfolio is currently at work growing, expanding, and or minimizing risk that they believe is within the market. In 2023, as we said before, it was negative 80 billion, while in 2022 it showed a positive 66 billion, likely due to the selling of securities within the year. These swings underscore that Berkshire sometimes liquidates investments or produces cash more often and will always be looking to deploy it into more further investments or more purchases, and that's why we have those outflows. Now, cash flow from financing. This section tracks cash movements related to equity and debt. Berkshire rarely pays dividends. So in the section where I asked, is there a dividend plus? There's not. And they don't issue new stocks. So equity financing isn't a factor aside from share buybacks. Instead, the main financing items are debt and share repurchases. The statement shows lines for, quote, short-term debt issuance, end quote, and then short-term debt repayment and long-term debt repayment, and a net line for debt. Berkshire's financing cash flow in recent periods have been moderate. For example, in 2024, they had some debt issuance and repayments, and that financing was negative $5.86 billion in 2024, meaning they repaid more than what was borrowed. Berkshire also repurchases its stock when it's deemed undervalued. Under the line that's indicated as repurchase of stock represents cash out for buyouts, the data suggests share buybacks were almost modest. Shares outstanding only fell by 0.05% year over year, implying only a small amount of buybacks. Thus, financing cash flows for Berkshire are typically negative, and that's the cash going out, reflecting debt paydowns and occasional debt buybacks. And there are no dividend payments, as we said before. So what are the net change in cash? Adding up all of the sections, we get a yearly cash flow in a typical year. It is a large inflow that is positive, but it gets offset with heavy investing outflows and some financing outflows when they want to choose to buy back shares. However, within specific years, the net change in cash can be positive, as we said before. So we always need to keep these things in mind, that when we're looking at how the business has inflows and outflows, this is a large conglomerate. There's a lot of billions moving around, and it really does depend on what the current circumstance is, what's the environment of risk, are there deals on sale, what's the interest rate. All of these are going to be playing a very large major factor. So let me see. Just going through here. The next part that I like to mention outside of flows is fear index based on financial health and liquidity. By all indications, Berkshire's financial health is extremely strong, so any fear index would be very low. The company's liquidity and balance sheet strength inspires confidence rather than fear. For instance, Berkshire's current ratio is 2.72 and a quick ratio is 2.55, meaning it has twice more short-term assets needed to cover short-term liabilities, and it also has a huge net cash position of $254 billion and low debt equity of only 0.18. Interest coverage is around 17.4x, indicating Berkshire earns many more times its interest expense, and it is therefore considered a very safe buffer. With the metric being 0 through 10, 0 being no fear, 10 being extreme fear of insolvency, it's going to be a 0 to a 1. They've proven themselves to be a AAA plus heavyweight, and therefore there's not much fear going on within the stock. Even the price right now is actually overpriced, but we're going to get to that. We don't have a lot of information on the exact due dates of debt, but looking from its relative history, no major announcements that have come out, we're very safe to say that it's a minimal. Remember, cash is 50x all of the near-term debt due. The bulk of Berkshire's $127 billion debt is long-term. $124.2 billion is long-term, not due within the next year. These are likely bonds and loans with staggered maturities extending over many years or decades. How do we know that? Well, considering that they have subsidiaries like BNSF Railroad and Berkshire Hathaway Energy often issue 10 to 30-year bonds. The data that we have here doesn't necessarily list a maturity, but given the small current portion, we would infer that most of all of these debts are beyond 2025. There's no intimate fear of refinancing risk. Its debt repayment schedule, we hope, at least from what we're scanning out now, from what we're looking, from what we're analyzing, the company can easily roll over or retire debts as they come due, using its immense liquidity. It's worth noting that even if a chunk of the debt matured in a particular year, the cash flow and cash reserves are more sufficient to cover it. The maturity profile is conservative, only 3 to 7 billion due soon, with 120 billion due later. Berkshire's debt ladder is very manageable, reflecting its presence for long-term financing. There's no concentration of maturities that would pose a problem, and the resources give the flexibility on waiting longer. They could have lower interest rates, as Donald Trump wants in the near-term future, giving them a major bonus. If they, had spiking interest rates, they could easily retire the debt now and just put that into U.S. Treasuries or other yielding bonds to get more of a return. So that's fair. Now, what are the market expectations for the current $492 share price? Share price, let's see here, was on the 15th of January. So if the share price is different from today, whenever you happen to listen to this, that's why. Now, at $492 for the stock price, the market is assigning valuations to Berkshire that imply moderate growth and a solid performance. It's not wild euphoria, but we can infer what's priced in by looking at the valuation multiples. The trailing PE ratio is 15.8, which is reasonable and roughly in line within the broader market, suggesting investors see Berkshire's current earnings as stable and worth around 16x. Intrinsically, the forward PE ratio is higher at 23.6, implying that analysts expect New Year's reported earnings to be lower than the last because 2025 might not repeat the unusual high investment gains of 2024, and this forward PE trailing would indicate the market knows that recent earnings on some one-time gains and they are priced in, but they are not giving it as an earnings normalization. The price to sale ratio is 2.8, for which a conglomerate is a mix of low margin insurance revenue compared to their higher end businesses. But it's not that expensive. Price to book is 1.52. meaning the stock trades at a 52% premium over the accounting book value. This suggests that the market is pricing in Berkshire's strong intangible assets as reputation and future growth beyond just the book value. The price to free cash flow is quite high at 55, a free cash flow yield of 1.8%, reflecting that Berkshire's current free cash flow is depressed relative to its market cap, possibly because too much of its earnings come from unrealized gains, which boast book revenue and the income that comes from it, but not free cash flow. Investors likely anticipate that cash generation will improve or that the cash hoard will be put to more of a productive use. And the current enterprise value to EBITDA is 7.8. Now, it means that the operating businesses are valued at a fairly cheap, price. Remember, these are stable utilities and industrials that are also owned underneath this same LLC. So, while the EV to the free cash flow is higher due to a temporary gap between earnings and free cash flow, again, this is the way that the structure and how their investments are set up to work, the current price reflects optimism, not exuberance, but the market is effectively saying, you're a high-quality, low-risk company. We'll pay 1.5 book and 16 earnings for it, and these multiples are consistent with a mid-single-digit compound growth with a continued high returns on equities, roughly at around 10%. It's not pricing in explosive growth, those that would warrant a PE far above 20, and they're not distressed, which would be a PB near 1 or below. If anything, investors are pricing in stability and a little bit of a safety premium. The stock's valuation suggests that they expect a steady, unspectacular growth and ongoing massive liquidity. $492 is the current price that the market believes that this compounding beast will end up being worth. And the real question is that necessarily true? In our own calculations, we believe that Berkshire's fair value is around the low 400s per share, whereas the dream entry, that would mean back up the truck and let's load up as much as we can, is roughly around $200. It gives us safety margin, and it would help us feel better at the end of the day. It would be a literal steal. So why not 200 again? Net cash per share is $118, but tangible book value of $150. $200 is 74% of the tangible book value, such as a discount is extremely unlikely, and this is why that it's a dream scenario. It's if the market collapsed tomorrow, what's the most solid company we could take advantage of to strengthen our portfolio before the correction were to occur? And a PE would be around 6 or 7, and this would be for a AAA- rated company. It is a literal steal, but the fair market value for us is between 400 to 420, depending on how confident you are about this. So the current price, in our opinion, is really overpriced, and we're not willing to buy something at that current market value. And at the end of the day, we also must remember they don't pay dividends. They don't give, the returns back as of other companies would. So my willingness is a little bit more larger because we need to be slightly more careful. Now, are there any write-offs, impairments, job losses, sentiment underperformance for current shareholders today? The financials show that Berkshire had a notable write-off in 2020 at $10 billion. They've recorded a huge impairment on precision cast parts and aerospace parts manufacturer in 2020 when the pandemic hurt the aerospace sector. From 21 to 24, there were no major write-downs reported. The line for write-downs are all blanks. So aside for that, there hasn't been any other major change. So at least for right now, while we think this is an extremely solid company, our belief is for people to avoid this temporarily, watch how it plays out, look at the data, and enter with caution when the market decreases to be able to get some of this beautiful conglomerate yourself. As of right now, my high recommendation is this is going to be a not interesting with a $200 price tag on my end, $225 if I'm being generous. if I want that position that bad. With that being said, this is Econ with Dave. I thank you so much for your time, and I hope you all have a wonderful day.